If you've ever looked at the stock market sitting at an all-time high and thought, I'll wait for it to come down before I invest, you're not alone. It feels logical. Why buy something at its most expensive point? But here's the thing. That instinct, as reasonable as it sounds, is one of the most expensive mistakes a long-term investor can make. And the data backs it up clearly. Today we're going to break down why an all-time high is not a warning sign, what history actually tells us about investing at market peaks, and what to do if you're still a little nervous about it. Welcome back to Compounding with Callie, where we compound some miles and our money. Let's start with the assumption built into the fear, that an all-time high means a crash is right around the corner. That feels intuitive, but it's actually not supported by history at all. Here's the data. Since 1950, the S&P 500 has closed at a brand new all-time high on roughly 7% of all trading days. That works out to be about one new record every 14 to 15 trading days, or around 20 new highs per year on average. In the 1990s, all-time highs happened on more than 12% of all trading days. From 2013 to 2019, it was 14% of all trading days. Even through two bear markets in this decade, the S&P 500 has hit all-time highs on 11% of all trading days. Think about what that means. All-time highs are not rare, dramatic events that signal danger ahead. They are normal, expected behavior of a market that grows over time. Every new high is just the market doing what it's always done, moving forward. And since every all-time high is followed historically by more all-time highs, waiting for the market to come down from one often means waiting on the sidelines while it just keeps going up. But here's a stat that might actually surprise you. Goldman Sachs analyzed historical data and found that investing in the S&P 500 exclusively on days when the market hit an all-time high has historically outperformed investing on any random day, producing strong returns over the next 1, 3, and 5 years. I'll state that again. Buying at all-time high has historically been better than buying on a random Tuesday. Since 1950, the average one-year return after a new all-time high is 12.7%, slightly above the overall market average of 12.4%. And investing at an all-time high between 1988 and 2020 led to a total return of 50% after 3 years, and nearly 79% after 5 years. The fear of buying at the top just isn't backed up by evidence. And here's one piece of data that reframes this completely. Nearly 30% of all-time highs since 1988 have been what analysts call market floors, meaning after hitting a new high, the market never fell more than 5% before going on to even higher levels. So about 1 in 3 all-time highs wasn't followed by a meaningful pullback at all. The crash that feels inevitable after a record high, it doesn't always come. And when it does, long-term investors recover anyway. Now look, if you're still uncomfortable about putting a large amount in all at once when the market feels stretched, that's completely okay. And we've talked about the solution to that multiple times on this channel. It's dollar cost averaging. Instead of trying to time the perfect entry point, you invest a fixed amount on a regular schedule, every week, every month, regardless of where the market is. When prices are high, you buy fewer shares. When prices dip, you buy more. Over time, it averages out, removes the pressure of picking the right moment, and keeps you consistently invested in building. You don't have to feel confident about where the market is today to make the smart decision. You just have to stay in the game. Here's the bottom line. An all-time high is not a red flag. It is the stock market working exactly as it's supposed to, reflecting the growth of thousands of real businesses over time. History shows us clearly that buying at highs has not been a poor long-term decision. Waiting for a pullback that may or may not come, while the market quietly climbs higher, is almost always the more costly choice. If you're a long-term investor, the best time to invest is consistently, over time, regardless of the number on the screen today. Don't let a record high talk you out of building your future. The market has been setting new highs for decades. It's very likely not done yet. Thanks for tuning in. Same pace next time. Keep compounding.